my name is Tom Katosa, just Chelsea mentioned. I work for the Virginia Credit Union, which we're the state employees credit union. We also partner with all state colleges and universities. So for those of you all of you students here are actually eligible to be members with us. We're, like most credit unions and some other financial institutions now, we're very passionate about financial literacy and education and helping people make good financial decisions. This is actually a unique experience for me today, doing one about financial technology, because normally I'm up here talking about like, oh, you should save your money and not spend your money on this and try to, build emergency savings and all these things you should do financially. Well, oftentimes I don't really get to talk much about the tools that are associated with doing those things. So there's a whole hugely massive industry called financial technology, or fintech, that is just like exploding out of Silicon Valley. And so we're going to kind of walk through a few different types of financial technologies that are available, as well as companies or organizations that actually offer those products. Disclaimer, myself and the Virginia Credit Union do not endorse any of these companies or organizations or products. We are going to talk a little bit about some things that most banks and financial institutions do internally that you don't need to use some kind of external service. And we're even actually going to talk a little bit about cryptocurrencies, because that is a form of financial technology. So again, we have 45 minutes to talk, and we're going to cover a lot, so it's going to be very, very high level. On your way in, you should have picked up some handouts, and I printed out 2 articles that I really liked in doing some research about like best apps from these different resources. Now, I get a lot of information from NerdWallet. I don't know if anybody ever looks at NerdWallet. They basically do like credit card ratings and rankings and stuff like that. I like a lot of their content. It's usually very well researched and well reviewed, so I use a lot of theirs. So you'll see, and we'll mention a bunch of these things as we kind of go through here. But this is going to be our agenda today. We're going to talk about some primary financial technologies that everyone's already very accustomed to, and a little bit of kind of the evolution of how these things came about. And then we're going to move into some more advanced things, such as like budgeting tools and apps, as well as artificial intelligence, robo-advising, and then again a little bit about cryptocurrency and blockchain, which is fairly sophisticated, but we're going to kind of break down like how it works and some advantages and disadvantages to using Bitcoin and Ethereum and all that kind of stuff. So as we go through, if you guys have any questions, feel free to ask. I may or may not know the answer. Another little disclaimer is I'm not the most technologically savvy person. I don't use like any of these resources myself. I have done quite a bit of research on them. I like to do things the old-fashioned way. Couple reasons. One, I have a banking background and a finance background, so I understand it. And two, second reason is a lot of these resources kind of came about for purposes of convenience, and there are fees and things associated with them. I don't like paying money for stuff I don't need to use. Like if it's a convenience fee, like I would prefer to actually just do it myself in most cases. And second, I'm very concerned about my privacy. Like I don't like putting my financial information in too many different places that are out of the control of myself. And so a lot of these are third-party apps where they do ask for access to your actual financial information. So that's where I get a little bit iffy personally. But again, that's a personal choice. A lot of these companies, all of these companies that we're going to be talking about, this is how they make their money, and so security is at the absolute utmost top priority for all of them, I can assure you that. But again, that's a personal preference. All right, so kind of going back to the beginning, which everybody in here certainly is young enough to not even remember a time where there wasn't online banking. This was the original, developed in the 80s, when the internet kind of started to come around, really kind of took off in the 2000s, and it allowed banking customers to move away from branches. So as soon as banks started to realize that they were having to pay less tellers and less bankers, they started dumping absolutely just dumping resources into enhancing these technologies, making them better, faster, safer. So a lot of stuff that you used to have to do in a branch, like transfer money from one account to another, or you'd have to wait until you actually got your bank statement in the mail to know what your account balance was if you weren't tracking it carefully. Online banking allows you to do a lot of those things just from a desktop computer or now from your phone, which we're going to talk about mobile banking here in a second. Again, standard stuff, so I'm not going to spend too much time on it. What I will tell you is that, like, starting in the early 2000s at the advent of online banking, a lot of people became very lazy with tracking and managing their finances. Like, if anybody remembers their grandparents or parents even having a checkbook register, logging all their transactions, reconciling their balance or their statement when they got it in the mail. Spending that time with your money, I think, is probably one of the most valuable things you can do to improve your financial health and achieve goals, because you're very connected to it. You're actually like able to kind of see it, and you're kind of forced to monitor it on your own. So that just kind of gives you that a little bit of extra incentive to track things a little bit more carefully. Checks are basically no longer even a thing. We're going to talk about that when we get to like payments and stuff like that. So around the same time, maybe a little bit earlier, stuff like the debit cards started to come along, and credit cards became more widely used, and that kind of falls under the technology advancement of like forms of payment. Now, kind of as we progress through using debit cards and credit cards, we have the chip technology, which has allowed for actual card usage to be much safer. And we're going to talk a little bit more about just direct digital payments in terms of like peer-to-peer payments, as well as other ways to like pay different vendors and organizations and things like that. Every advancement that's come along, there has been an additional cost associated with it, but most merchants and things like that just include that in the cost of the product or service, right? So like, here's a good example, like a credit card. Credit card company charges a fee anytime the credit card is swiped, okay? They charge the merchant, whatever, you know. So I don't know if you're aware of this, if anybody's tried this, and there's some people have tried to do this to maximize their benefits and their points on their credit card. If you try to pay your tuition here at Virginia Commonwealth University with a credit card, they transfer that fee directly to you, and you have to pay an additional 3% of your tuition if you pay with a credit card. I don't know if anybody's aware of that. If you've ever been into like a gas station or convenience store and they say we do not accept debit or credit card transactions under $5, that's because there's a fee that's associated with it. They don't want to have to pay the fee. Okay? The chip technology, though, is fantastic. We should have been using that years ago. That has to do with like identity theft. We're not going to get into that too much. Okay, so when fast forward to 2007, iPhone, yay, comes along. Now everything's gone on to mobile. Massive advancements in online banking have been, like, the major advancement in online banking when it comes to mobile is mobile optimization, where there's an app associated with pretty much any financial institution you may do business with, including investment organizations like the Principal or Fidelity or whomever, TIA, whatever it is, E-Trade, all these kinds of places. There's also mobile web, where basically you're coming in through your web browser, and most organizations try to optimize just so it basically looks nice. A lot of times the features are going to be very similar, but sometimes there are things that you can do online that you can't do through mobile banking. There are sometimes things that you can do through mobile banking that you can't do online. Primarily, the major, most awesome advancement has been personal remote deposit capture. So being able to take a picture of a check front and back, and it automatically deposits in your account. Now, there's risk associated with that for the financial institution side, so usually there's going to be limits on that. Like if you get a $8,000, $10,000, $15,000 check, they're not going to let you just deposit it through your cell phone. You have to come into a branch, and usually there's holds and things like that. Also, a lot of times financial institutions do kind of adhere to a similar policy that they may have through their ATM deposits, where you're instantly given credit for a certain amount, and then the remaining amount clears overnight. It's really kind of, the way that payments work is really kind of antiquated technology. Like in the way of our instant communication society, you would think that it would be easy to just send money from one person to another, but because of the way that our legacy financial institutions and the Federal Reserve System is set up, and being able to having to verify account transfers and things like that. It takes a long time for money to actually be moved from one account to another. Like physically, it takes a long time for all of the people to clear those transactions. Like trillions of dollars are moved throughout our global economy on a daily basis. So it's kind of a lot of volume. And there's a lot of legacy institutions that make a boatload of money off of that system staying the same. So that's one of the things that blockchain and Bitcoin and stuff like that is going to attempt to change, but we'll see if it actually has any traction. Okay, so these are the things that we're all already familiar with, and I can guarantee everyone in here, if you have a bank account, you already use this stuff. It's kind of commonplace now. This is now the bar. This used to be an add-on feature that banks would offer. Now this is the bar. You have to have at least these features for anybody to even consider you. Like a lot of smaller credit unions and small community banks may not have the resources to build out these kind of robust technologies, but if they don't, they're not going to have any customers. So this is the level to compete. So quite a few years back, PayPal, obviously we're all familiar with PayPal, was kind of a leader in this peer-to-peer digital payment technology. There are multiple different business models, and there are multiple different ways that these kind of companies or organizations process their transactions, or ways you are able to utilize their service. And there are different fee structures that are involved in each of them. Okay, so peer-to-peer allows you to send, obviously as it sounds, directly from me to you, right? PayPal was the original. There is a couple different ways that you can link or associate your money to PayPal. Like you can actually set up to where it automatically comes out of your account. You can prepay or pre-fund PayPal, or you can link it to a credit card. Different ways that you choose to do that will have different fee structures. The newer technologies, Venmo and Zelle, are kind of similar offshoots of that, but they've made it even easier and more simple to connect peer-to-peer. Now, with some of these, like I was in my research, I kind of figured out how some of these places were. Does anyone use these services? Anyone use any of these? Which ones do y'all use most? Raise your hand if you use PayPal, or probably has PayPal. Anybody here use Venmo? Oh, a lot of folks. Okay. Anybody have Zelle? Okay. So Venmo and Zelle are almost identical in function. The primary difference is Venmo, you are not required to, you don't have to have a bank account that's associated with it. Zelle is a company that kind of came around fairly recently that mimics what Venmo already does, which is like instant peer-to-peer transfer of funds, but they actually have a really smart business model. They went directly to the banks, and you have to have a bank account that is with Zelle, or it's more beneficial for you to have a bank account that's with Zelle, that uses Zelle, and they've got most of the primary financial institutions. And so if your bank uses Zelle and my bank uses Zelle and I want to transfer you money, it happens instantly. Okay? Yes?
So is MasterCard checkout and Visa signatures out the same thing?
No, that's a little bit different. We're going to talk about that next, actually. That's like a form of a digital wallet. Okay? Kind of the same. Again, all of these, yes?
Since Zelle is associated with your bank account, because like I have Bank of America and it's built into the app, is it safer to use Zelle than Venmo?
Safety is an interesting thing. I can't speak to that. I mean, when you transact through your financial institution's app or system directly, they have certain levels of insurance and fraud protection and things like that some of the third-party organizations may not. Now, in terms of like safety, they have Bank of America has like decades of online safety and massive amounts more resources than a company like Venmo, even though Venmo is actually a subsidiary of PayPal. But Bank of America's been around forever, and so they have worked on their security and safety for a long time now. For fraudulent transactions, I was actually in my research noticed that they mentioned something that anytime you send money through Zelle or through Venmo, if you do not know the person and it's a transaction done fraudulently, you are held liable for that. So it's not like if you use your debit card and like somebody on the other end is fraudulent, like you actually are liable for sending that money. So that's like a complete loss for you, which that's one of the dangers of using that service. But the purpose of it is designed for like stuff like splitting checks or doing like small dollar transactions back and forth. Zelle is only run nationally here, like you can only use it within the United States. I think Venmo is too. PayPal you can do internationally, and there's another one called Zoom that you can do internationally that starts with an X. But primarily, like with all of these, the fee structures definitely vary. So like it's actually no cost to transact money with Venmo, like between two people. But when the money gets deposited into Venmo to get it out, there's a fee. Like to have them transfer the money back to your bank account, there's a 25-cent fee. And then they're actually November 6th of this year, like coming up this week, next week, they're going to be switching their fee model to, it's going to be 1% of the total transaction coming out of your account back into your bank account, out of Venmo back into your bank account. So again, you got to watch out. You're paying for the convenience, though. Remember that you're paying for the convenience. So it's very important for you to pay attention to the fee structure. All right. Now, digital wallets are a little bit different. This actually stores information for credit cards and debit cards that you currently utilize. It makes online shopping substantially easier and more streamlined because if you have MasterPass or whatever the one for Visa is, then basically all it does is it preloads all of your card information and you say check out here and you click yes and you're good. Now with stuff like Apple Pay and Samsung Pay and Android Pay, there's a different form that actually uses your cell phone. So it is a way that you can connect online to these retailers and merchants and stuff like that and pay online. But it also has an additional feature using the RFID capability from your cell phone to where you can like just tap and pay at different merchants. And now all of the new card readers have that capability. Okay. Now, in terms of like safety for this, allegedly it's more safe than using the old kind of debit card. So maybe I will talk a little bit about the cards. Okay, so you get this card, right? Here's my credit union debit card. Okay, so and for those of you that came to my identity theft class, I think we went over this here too. So on the back of your debit card, there's the magnetic strip. This is the most dangerous form of payment because it's your card number imprinted magnetically on this strip here. When you swipe your card number gets transmitted from your card to their card reader, and that information is stored until the transaction clears. And it's your actual card number. Okay? Now, with the chip, when you put in the chip, a randomly generated number associated with your card is created for a one-time use for that payment. So like the transaction information is captured, and then overnight when all the transactions come through, the number associated with your card, it hits your bank account, and that's when the transaction is fully processed. Does that make sense? Y'all follow me with that? Okay. Now, with Apple Pay and Samsung Pay and Android Pay with the RFID, it uses a similar unique generated code capability. Now, I don't know how good like RFID readers are for like criminals and stuff like that, where they, you've probably seen like somebody can like brush by you and capture your information like digitally. I don't know about like safety when it comes to that. I've never used any of these services, so I can't speak to safety, ease of use, any of that kind of stuff. I don't know why. I don't know. I like using my card. It's preference, right? And when I go online to buy stuff, I never store my information on any of their websites. I don't use MasterPass or any of that stuff. They claim it's more secure. I just, whoever they is, they say a lot of stuff. So I know what I feel comfortable with. One of the benefits, though, additional benefit beyond storing all of your personal information, is you can also store like your loyalty cards. So like if you go to Kroger and you're a Kroger valued customer or whatever, it automatically recognizes that, which is kind of cool. Okay, so this is where things have kind of progressed now, where a lot of people are interested in these kinds of things, like budgeting tools and money management tools. There's a lot of different models, a lot of different forms, a lot of different companies out here that do these things. The most common and the one that most people always cite as being the best, or the whatever, is Mint.com. Has anyone ever heard of Mint? Anyone ever used Mint? Or actively use it? Yeah, kind of sometimes. Mint.com is a budgeting and money management tool. It's kind of like very, very basic financial planning software, but really not. It allows you to connect multiple different bank accounts to one central website where you can log on, it stores your information, and every time you log on it will refresh, and it allows you to help track your spending and categorize your spending, create budgets, and all this kind of stuff. Okay? If anybody's ever taken been to any of my other classes, I can't tell you how valuable that information is. Collecting and gathering information and data is critical for making decisions about the future, which that's all money management is. That's all financial planning is. It's like, what am I doing today and how's that going to impact my financial situation tomorrow, right? Nobody in here won that Mega Million or Powerball, right? No. So you have to think about what you're doing now to impact tomorrow. That's all this is. Having a budget, using these tools does not force you to make better decisions. It should help guide you to make better decisions though. Like if you don't know if you're spending too much money at Starbucks unless you see that you're spending too much money at Starbucks. Like that's kind of the long and short of it, right? So a lot of times your financial institution actually has a feature like this embedded in their online banking. At Virginia Credit Union, we offer a money tracker feature. It only looks at the last 3 months, and it allows you to average out over the last 3 months what your spending is on different categories. I know Wells Fargo has a fairly robust version of that. Some of them do allow you to connect to outside financial institutions, others don't. Ours does not. Ours is only with your checking accounts at Virginia Credit Union is what's looked at in our money tracker, which is why a lot of people like going to these third-party services. Okay? Now, like software packages like Quicken are very beneficial as well. Quicken is similar to Mint, but it's housed on your computer. It's not like cloud-based, although I think they actually recently went to cloud-based servers and system. But basically, this just allows you to follow where your money's going, so you can better plan and manage for the future. Like if you have an objective to get out of your student loan debt as quickly as possible, you need a plan to do it, and you have to understand where your money's coming in, where it's going out, and this kind of gives you a visualization of how to do that. Okay? Now, Mint is most commonly referred to because it's free, and it's made by the same people that make Quicken. So it is completely web-based, and you may ask yourself, well, if it's free, what's their business model? And again, this is why I guess I'm just a paranoid person. Like, if it's free, you know what they're selling. Selling your information and advertising directly to you and marketing directly to you. I did use Mint a long time ago, and I went back to using Quicken in an Excel spreadsheet. Like, I use Quicken to help me, but I actually just have an Excel spreadsheet, which is really the best way to do it, because I'm hands-on. I get to follow it, I get to see it, touch it a little bit more. So with Mint, you give it access to all of your online accounts, it loads in. Now, there's another one that's very, very popular called You Need a Budget. That one's not free. But again, when it's not free, they're not selling your data, they're not soliciting you other products or services. And I've heard very, very good things about it. In fact, when I went to go re-up my Quicken membership, subscription or whatever, I really considered moving over to these guys. The guys who created it are really cool too. They're interesting folks. Okay, so saving and investing. Now, there's a whole ton of this kind of stuff going on right now. We're not talking about artificial intelligence and that kind of stuff yet. These are things, Robinhood's basically just like a very super low cost way to kind of start investing. Acorns is, a lot of people actually probably have a function like Acorns already on their online banking or through their bank that they use. What Acorns does is it typically rounds up your transactions, and every so often it'll take that rounded up amount and it'll transfer it over The difference though is at most banks and credit unions, they just transfer the money out of your checking account and put it into a low interest rate savings or money market. Even money market rates are still relatively low. This one actually puts the money directly into investment products. With Acorns, there's a fee for it. It's like $1 a month, and when if you're starting out small, like the expense ratio on that is actually really high because you're not really investing a lot of money. Like only when you start to accumulate a ton of money is the expense ratio actually like relatively low. So it's a good way to kind of get started though, and it really actually is very good for college students because you don't have a lot of time to think about investing. You don't really have a lot of extra cash flow to deal with, that you have available to you. I do my own investing just through Vanguard myself, personally. Okay. Artificial intelligence and robo-advising. Now, Personal Capital, Betterment, these are some of the most highly rated robo-advisors. Have you guys heard that term robo-advising before? No? Okay, so financial advisors make money a couple different ways. Some of them charge, fee-only advisors charge you a fee to help you manage your money, and they give you advice because you're paying them to do that. Other advisors or brokers make money off of selling you products or services that do benefit you, but they make commissions off of that. And anytime they're making a commission, that's less money for you, basically. Having an understanding what your expense ratio is can mean the difference of $500,000, $1 million, or more over the lifetime of your total savings. So the way that the fees are withdrawn and the way that the fees are compounded over time, it's a substantial difference between half a point, 50 basis points, right? So a lot of times financial advisors use fairly sophisticated software to maximize your return and reduce your risk. It's relatively new, within the last half century. This thing in investing called portfolio theory, which basically does that. It's very complex mathematics to maximize your return, reduce your risk, and optimize your savings based on your strategy and all that kind of stuff. So what some very smart tech people did is they basically took portfolio theory and put it into a software platform, and so it kind of is democratizing very expensive financial advising with us. Now, Betterment and Personal Capital are very, very highly rated in terms of the amount of value you get out of it, but there is still a cost associated with it. Okay, I think with each of those, Betterment is actually free up to a certain point, but if you want their actual advisors a human being to speak with, then they start to charge a fee at that point. I think with Personal Capital, it's 0.25% or something like that is their expense ratio, which is very low compared to actively managed advisors. Okay. Now, the benefits, if you're a do-it-yourself, a DIY investor, a lot of people like to just put money in index funds and try to get the cheapest thing possible, and you do broad-based index investing and things like that, which is very valuable. That's the way I do mine, because I know enough about it to be dangerous, I guess. This really helps with optimizing your taxes and understanding what your strategy is with student loans and all that kind of stuff. That's the value of an advisor. So this is basically just an online version of that. Now, Digit's a little bit different. Digit is a service that's used that looks at your spending habits and actually monitors what your habits are and what your bills are, and over a period of time, it actually recommends different points in which you can save some money. So it looking okay, so this month you didn't spend quite as much on going out to eat for lunch, so we noticed that this month you're going to have this much left over, $10 left over. Do you want to put it in savings? You say yes, and then it doesn't. It has its own account. There are fees involved. Again, I've never used that service, but I hear it's pretty cool. But again, this is more about micro investing, micro savings, small bits at a time. If you really want to be financially healthy, you pay yourself first. Whenever you get money, you save a part of it, a relatively large part of it, and you work to pay down debts and stuff like that. These things kind of help little bits at a time. Does that make sense? Okay. Again, there's more information on those two handouts about some of those different choices. Always, always, with anything, do your due diligence, read reviews, read independent reviews, read everything on an FAQ section before you sign up for anything, read everything about the fee structures before you sign up for anything. That's my advice. Okay? All right, how am I doing on time? We good? Oh, good, we got like 15 minutes to talk about Bitcoin. Anybody invest in Bitcoin? No? Me neither. I'm not either. Okay. Does anyone know how it works? Or what it is? No? Okay, cool. Then we're gonna learn some things today. Again, this is the very, very basic and fundamental thing. Like I told this before, I'm not a tech person, so I could never set up my own rig to like mine Bitcoins and all that junk. So before we kind of start, like Bitcoin and cryptocurrencies are something that have been kind of developed or designed to replace our current monetary system. So in order to understand why someone would want to replace our current monetary system, I'm going to explain very, very high level how our current monetary system works. Okay? So money is really nothing. Like we have a fiat currency in the United States, so it's backed by nothing. It's backed by the full faith and credit of the United States government. There's no tangible item that you can take $1 into the bank or the government and say, hey, give me this because I have this many units, right? Before 1971, I want to say, or maybe 76, the United States was on the gold standard. So basically, you can actually, at that time, you could actually go and redeem your dollars for physical pieces of gold, okay? Which is also kind of a weird thing because gold only has value because we give it value, right? So money is just like, honestly, it's a construct. Like it's a social contract more than anything. So some qualities of any kind of money or currency is that it's a store of value, it's a unit of account, and it's a medium of exchange. Like that's the primary definition of what money is, right? So, I mean, if we want to go back to the original financial technology, the invention of money and credit really is the beginning of money. Because before that, you had the barter system. Like I have something you want, you have something that I want. You and I decide on what we think is fair between the two of us, and we make that trade in tangible, physical items or goods or services, right? What money did is it allowed for a standard medium of exchange to be placed, and it basically gave everything a unit value that we could compare easily and evenly, right? So like everything has a price, everything has a dollar amount. Okay, now the value of the dollar is based on supply and demand. It's kind of like basic economics, like gold for example. Gold once was considered a form of money. Why do you think gold was considered a form of money? Yeah, right. But there really wasn't, I mean, there was no reason to. Honestly, like the more that sociologists look at it, gold was shiny, it doesn't corrode, it's relatively lightweight metal, and it's pliable, so it's easy to make coins and stuff out of it.
It's more stable.
No.
It's not.
It fluctuates. It fluctuates because there's a limited supply and because there are other things that are used as currency now, primarily. Gold does fluctuate greatly. Like the value of gold swings relatively substantially compared to currencies. Now, currencies do also fluctuate in value over time too, but they have to fluctuate based on something else. Like the value of the dollar in and of itself is kind of irrelevant, but the dollar versus the Chinese yuan or the peso or whatever, the euro, that's where their currency traders make their money. We're getting off topic. That's a little bit more complex. But kind of like with gold, the dollar only gets its value because we collectively decide that it has value, basically. The government also added a couple different things to kind of ensure that we would always value it. like it's legal tender, so it's the only thing that the government, you are required, you're obligated by law to take dollars for any outstanding debts in our society, and it's the only thing that the federal government will take to pay your taxes. So you can't pay taxes in gold. You have to convert that to cash and pay the government back in cash. Okay. The reason that the way that it's created, the way the money is created in our society, and that kind of feeds into how this works, is the United States Treasury issues bonds, and the bonds are bought by the Federal Reserve and by private investors and by foreign investors. So that's what sets the price of the bonds, but they're really literally created out of nothing. Like the Federal Reserve comes into the Treasury and just says, okay, here's your money, and they create it out of nothing. That's how that's what the government is able to spend. Now, individually, there's a much larger and broader way that money is created through the actual banking system. It's called fractional reserve banking. It's really fascinating if you get into it. But so here's how that works. Banks who have an account at the Federal Reserve and who are FDIC or NCUA insured, like NCUA is a credit union version of FDIC, so it's federally insured money. We're required to keep a certain amount of cash on our balance sheet. Okay, that balance sheet only requires a small percentage of the actual loans, which on a credit union or bank, that's the asset side of our balance sheet is the loan, whereas the deposit is the liability, because we have to pay interest on the deposit. Does everyone follow me so far? All right, this is kind of weird, right? All right. So we're required to keep this amount on our liability, on our cash on our balance sheet, and we're able to lend out like 10 times that amount. So you come in, you deposit $10 into an account at this credit union, I can actually go out and lend you $100, and based on your $10 that you gave me and that additional $90, I literally wrote it into your account and created it out of nothing. That's what's called fractional reserve banking. So your money supply is created by the banks out of nothing based on credit. Right? Crazy. All right. So a lot of people think that the way that this thing is set up, it's corrupt, and the central government and the central banks are all in cahoots, and that's what's leading to income inequality and and there's probably some history and merit to some of that. So a lot of people who are a little bit, I guess, more libertarian leaning and are not a fan of central planning or central governments decided to create a currency that is independent of all central banking, and that's where cryptocurrencies came from. So cryptocurrencies, Bitcoin is the primary example of cryptocurrencies, but there's I think there's like 1,500 out there or more now. So cryptocurrency is a digital currency. It uses encryption. Because of the way that the code was written, it regulates the generation of new units. Okay, so the Federal Reserve has direct control over how much money is in our system, circulating in our system right now. Okay, they do that by calling on not renewing bonds and all this kind of stuff. One of the additional primary functions of the banking system as it stands today is to verify transactions. So like we were talking about how it takes time for me as a vendor to verify that you as a customer have money in your account, and I have to actually go to, the way that all that works is like Visa will go to the Federal Reserve and then, well actually they go through ACH, but there's like multiple different levels till I get to your bank and actually get to take your money, which that's the point of the whole thing. This kind of skirts around all of that, okay, and it's direct individual transactions. Now, cryptocurrency is not blockchain. Cryptocurrency uses blockchain technology as a way to verify transactions, okay? So the way that works is, this is how you get it. Okay, so how do you get cryptocurrencies? You can either go to a third-party vendor or just buy it, okay, but that's really kind of sketchy because it's a relatively new technology. We're going to talk about that in a second. You must have a digital wallet. Coinbase and places like that offer digital wallets. So you can either sell a product or service and accept it as payment, as a form of payment. I don't know if y'all ever read that article about 50 Cent. Back when Bitcoin wasn't worth anything, 50 Cent sold an album and he was like one of the first people that just like sold it on his own and accepted Bitcoin. And then like all of a sudden he like years later he's like found his like coin, like his token was like, oh, I got like millions of dollars sitting here in this. He didn't even know. The first Bitcoin transaction was for like 50 Bitcoin for a pizza, for like one pizza. And like that 50 Bitcoin at the peak in December of 2017 was worth like, I don't know, it was like trading at like $20,000 for a Bitcoin. So it's like, I mean, it's like crazy. It's like crazy. Which that's another one of the downfalls that we're going to talk about here in a second. So you can either buy it from a broker using cash, you can sell a product or service or accept it as a payment, or you can actually mine Bitcoin, which is kind of a weird term, by verifying transactions. So that's how this works, all right? So the way that it works is like you have two parties that agree to a sale of a particular product or service. So like you want to sell me a boat, and we agree to a price, and we're going to transact in Bitcoin. Well, we find out whatever we agree on, how many Bitcoin you're going to give me for my boat, and then we say, okay, she's going to transfer me this amount of Bitcoin, and so we send it out to the entire thing saying we're going to do this transaction, and everybody on the system is going to verify it. So that goes out to this like localized network of computers that verify the transactions. All these different individual computers are called nodes, and they hold the entire, every computer that's on the system holds the entire ledger, okay? And so the first few people who get a hold of this transaction actually verify that you are you and you have that amount in your account and I am me and I have, I'm the recipient and we've agreed upon this. And so they run these mathematical algorithms, and that's what's called mining. Every time your computer verifies a transaction, you get a little tiny piece of that transaction, right? That's how Bitcoin is actually created, okay? Now, they use like sophisticated mathematical algorithms to do all this kind of stuff, and multiple different computers actually do this at the same time. Once it's been verified by enough computers within the system, then it's bundled up into a block, and then that block is added to the general ledger. Now, it's almost impossible to change the original general ledger. As soon as anyone tries to change it, then it is very noticeable based on how it's recorded over time, okay? So because of that, it's like, it's impossible to undo a transaction. Like, it's almost impossible to undo a transaction. But it does not require a third party to verify transactions. Everybody who's on it is the one who are saying like, yeah, this is good. So who are the people that verify transactions? Well, banks right now in our system, banks verify transactions, and the automated clearing houses and the Federal Reserve verify transactions. So we just have to have faith that they're being honest. Okay, again, I guess I'm just paranoid again. But with Bitcoin, this process takes about 10 minutes still. I think it may be getting a little, as that kind of boom happened, like more servers came online and the capacity grew. But it does take about 10 minutes to actually complete a transaction. It takes a ridiculous amount of actual energy to run all of these servers. So it's not efficient in terms of energy. So advantages and disadvantages of Bitcoin. All right, you can see up here the advantages. It's decentralized, so it's not controlled by a central bank. It is in limited supply, so that's another one of the components of gold, of precious metals, is that you can't, alchemy never was actually invented, right? There is no way that you can just make gold. Gold is gold and it's a limited supply. That's why a lot of people also like to invest in real estate, because planet Earth is a defined space. It's a limited supply. And real estate, like everyone needs a place to live, so demand is every human being on planet Earth. So limited supply, a lot of demand. That's why real estate traditionally goes up in value over time. If all of a sudden if enough people think that gold isn't worth anything, then it's not worth anything, right? If enough people don't think the dollar's worth anything, it's not worth anything. A lot of people make this argument about Bitcoin because there is nothing other than the ledger itself that gives it any kind of value. It's that supply and demand function, but there's no federal government, there's no regulation, there's no physical, tangible asset. It is what it is, and people just transact because they choose to. Because it's of limited supply, you can't just have somebody like we've recently been going through that just opens a spigot of cash and makes inflation skyrocket. That's going to happen shortly in our economy because of what happened the past 10 years. If you believe economists, but economists can be wrong, and they are often. It's secure because it uses encryption techniques and decentralized stuff. You have time? Okay. Lastly, disadvantages, of course. It's very speculative, so the value swings very widely. It's not a good use of transaction or currency right now because tomorrow it could be worth like 15% worth less than it's worth today, subject to fraud. And it does rely on a network, which means you have to have internet connectivity and power. So I hope this was beneficial for you. Do your research, do your due diligence, do it old school, that's what I like to do. Just try to be smart about it.